Hello, future financial leaders. Welcome to the fascinating world of job order costing. I'm thrilled to guide you through this critical accounting system that separates successful custom manufacturers from those heading for trouble. Today, we're diving deep into the system that serves as your financial GPS when producing different products for different customers. Without it, you're wandering blindfolded through a financial wilderness. With it, you've got turn-by-turn directions to profitability. By the end of this session, you will be the hero who catches the $10,000 overhead allocation error before it destroys your company's quarterly profits. Your future boss won't just thank you. They'll wonder how they ever survived without you. Our roadmap today will take us from core concepts through journal entries and financial statements, all the way to real-world applications that drive business decisions. Buckle up. This is going to be transformative. Before we jump into the technical details, let me share a sobering reality. 3 years ago, a 50-year-old furniture manufacturer with 200 employees filed for bankruptcy. The cause? A $10 million costing error that had accumulated over just 18 months. Their job order costing system used machine hours to allocate overhead when direct labor hours would have been far more appropriate. This seemingly minor technical choice created a cascade of underpriced products, leading to millions in invisible losses hiding behind apparent profitability. Think of job costing errors like a tiny leak in a boat. At first, it's barely noticeable, just a few drops of water. But ignore it long enough, and suddenly you're frantically bailing water as your vessel sinks into the financial abyss. Small costing errors, multiplied across thousands of products, create financial disasters just as surely as small leaks sink mighty ships. Establish our foundation with 4 critical terms. Think of these as the alphabet of your accounting language. Without them, you can't spell financial success. First, job order costing is the system used when you're making different stuff for different customers. It's perfect for custom manufacturers, construction companies, and professional service firms. Think of absorption costing like packing for a camping trip. For beginners, it's like making sure you include everything you need, not just the tent, but the stakes, rainfly, sleeping bag, and even the mosquito repellent. For professionals, it's the GAAP compliant method that includes all manufacturing costs and inventory valuation. Which of these concepts seems most challenging to you? Take 5 seconds to identify it. We'll make sure it clicks before we're done. This slide reveals the magical formula that powers job costing. The predetermined overhead rate equals estimated total manufacturing overhead divided by the estimated total allocation base. For example, if Custom Creations estimates $500,000 in annual overhead and 10,000 direct labor hours, their rate would be $50 per direct labor hour. Early in my career, I consulted for a cabinet maker who refused to use predetermined rates. They insisted on calculating actual overhead for each job after completion. The result? Massive delays in billing, cash flow nightmares, and pricing inconsistencies that confused customers. Don't make this mistake. Think of predetermined overhead rates like meal planning for the week. You decide Sunday how much money you'll spend on lunches all week, so you know how much to budget per day. It's a strategic estimation tool that enables timely decision-making in the face of cost uncertainty. Just last month, IKEA announced they're investing millions in improving their predetermined overhead rate system. Their CFO stated that even a 1% improvement in rate accuracy could save them over $20 million annually across their global manufacturing operations. Meet the trinity of manufacturing costs. These 3 components form the backbone of job order costing. Direct materials are the physical items becoming part of the product. The wood and furniture, the fabric and clothing, the components and electronics. Direct labor represents the wages of workers directly creating the product, the carpenters, seamstresses, and assembly technicians. Manufacturing overhead includes all other production costs: indirect materials, indirect labor, factory rent, depreciation, utilities, and more. Here's the challenge. Direct materials and labor are like visible icebergs, easily traced to specific products, but overhead is the massive underwater portion, essential but impossible to directly link to individual units. Our job order costing system creates a systematic way to allocate these hidden costs. Think of these three cost components like building a house. Direct materials are the lumber, bricks, and windows, physically becoming part of the house. Direct labor is the carpenters, electricians, and plumbers, their time directly creating the structure. Manufacturing overhead is the architect's design, building permits, and construction equipment, essential but not directly visible in the final product. To track costs in a manufacturing business, we need specialized inventory accounts. Think of these as financial pools where product costs accumulate and transform. Raw materials is like your pantry before cooking. Work in process is your kitchen during meal prep. Finished goods is your dining room table set for guests who haven't arrived yet. And cost of goods sold? That's the satisfied guests who've eaten your food and left with full bellies. Remember this fundamental equation for all inventory accounts. Beginning inventory plus additions equals ending inventory plus transfers out. This balance governs every account in our system, just as surely as Newton's laws govern physics. Think of these inventory accounts like the journey of a salmon. Raw materials is the fish egg waiting in the stream bed. Work in process is the growing fish making its way downstream. Finished goods is the mature salmon ready to be caught. Cost of goods sold is the fish that's been caught and served at a restaurant. Each stage represents a transformation, with costs flowing from one account to the next until they ultimately become expenses matched against revenue. This slide reveals the big picture of job order costing, the journey costs take through your accounting system. Study this flowchart carefully. Understanding this path will make everything else make sense. Think of this cost flow like a river system. Costs start in different tributaries, but all flow into the main river of work in process, then downstream to finished goods, and finally to cost of goods sold. Let's think of this cost flow like a movie production. Raw materials is like the script, props, and costumes before filming starts. Direct labor is the actors and crew working on the set. Manufacturing overhead is the director, lighting, studio rental, and editing equipment. Work in process is like the movie during production and editing. Finished goods is the completed film ready for release. Cost of goods sold is when audiences watch the movie and the studio recognizes revenue. This flowchart is your mental model for everything that follows. If you ever get confused, return to this visual pathway to regain your bearings. Let's see this system in action. First up, buying materials. When Custom Creations purchases $5,000 worth of oak for future production, the journal entry is straightforward. We debit raw materials for $5,000 and credit accounts payable for $5,000. The materials are now tracked in inventory, waiting to be used. This transaction is like loading your refrigerator with groceries. You're stocking up on food, but haven't eaten anything yet. You've increased your food inventory and created an obligation to pay for it. Quick question: what would happen if they accidentally debited finished goods instead? Take 5 seconds to consider the consequences. They'd be overstating ready-to-sell inventory and understating raw materials. When they later try to requisition materials that aren't properly recorded, their inventory system would be a mess. Small mistake, big consequences. Now production begins. Custom Creations pulls $200 of oak from raw materials to build a custom chair. That's direct materials going straight into work in process. They also use $50 of sandpaper and glue that can't be traced to specific chairs. That's indirect materials going to manufacturing overhead. The T accounts show this transaction clearly. Work in process is debited for $200. Manufacturing overhead is debited for $50. And raw materials is credited for the total $250. I once consulted for a wood shop that recorded all materials as direct, even glue and finish. Their job costs were inflated and their overhead was understated. Remember, if it can't be economically traced to specific products, it's indirect. Think of this materials requisition process like preparing ingredients for a fancy dinner. The expensive steak that's the centerpiece of the meal, that's direct materials. The pinch of salt, sprinkle of herbs, and olive oil for sautéing. Those are indirect materials, just as you'd track the steak's cost, but not each grain of salt. We trace direct materials to specific jobs, but pool indirect materials in overhead. Boeing does this on a massive scale. They track titanium components for each specific aircraft, but pool small fasteners, adhesives, and sealants as indirect materials in manufacturing overhead. Labor follows the same pattern as materials. Think of direct labor as employees who touch the product, and indirect labor as those who support production. When Custom Creations pays $300 to carpenters directly building chairs and $150 to supervisors overseeing production, the accounting treatment splits by type. Direct labor is debited to work in process, $300. Indirect labor is debited to manufacturing overhead, $150. The total $450 is credited to salaries and wages payable. Direct labor creates your product. Indirect labor supports your production. One goes to work in process, one goes to manufacturing overhead. Same payroll account, different destinations. Think of labor costs like a Broadway production. The actors on stage are directly creating the performance that customers pay to see. The stage managers, lighting technicians, and ticket sellers are essential, but don't directly perform. Both groups get paid from the same payroll account, but their costs are treated differently in the accounting system. Understanding this distinction is crucial for accurate job costing. You'll be able to explain why the production supervisor's salary isn't charged directly to products, even though many companies incorrectly try to do this. Manufacturing overhead includes a wide variety of costs. Custom Creations records $1,000 in factory rent, $500 in equipment depreciation, and $200 in utilities. The journal entry debits manufacturing overhead for the total $1,700, with corresponding credits to cash, accumulated depreciation, and accounts payable. Did you know that rising energy costs have forced furniture manufacturers to increase their overhead estimates by 15% this year? Companies with outdated predetermined rates are now finding massive underapplied overhead at year-end. Think of manufacturing overhead like the infrastructure costs of a city. The roads, utilities, public transit, and emergency services benefit everyone. Individual citizens don't directly pay for each specific streetlight or fire hydrant. Instead, the city collects taxes and allocates these costs across the population. Similarly, overhead costs benefit all products but aren't directly traceable to specific units. What other overhead costs might a furniture manufacturer incur? Take 10 seconds to list 3 in your notes. This is where the magic happens. We're taking all those indirect costs floating in manufacturing overhead and attaching them to specific jobs using our predetermined rate. For the chair project requiring 10 direct labor hours at a $25 per hour overhead rate, we apply $250 of overhead to the job. The journal entry debits work in process for $250 and credits manufacturing overhead for $250. We're basically telling overhead costs. You may be indirect, but we found your direct connection to this specific job. It's like giving a social security number to someone who's been living off the grid. Suddenly, they're traceable. Think of overhead application like charging your phone. Your phone battery needs electricity. The electricity from the power plant flows through the grid to thousands of homes. Your charger converts and applies just the right amount to your specific device. You don't pay for each electron directly. You pay a rate per kilowatt hour. Similarly, jobs don't receive actual overhead directly. They get overhead applied via a predetermined rate. The manufacturing overhead account is what accountants call a clearing account, like a financial weigh station. Costs enter on the debit side as they're incurred, then exit on the credit side as they're applied to jobs. At year end, we'll deal with any remaining balance. Stay tuned for that. There are only two types of costs in the world: those that become part of inventory and those that are expensed immediately. You must know the difference. Non-manufacturing costs, like sales commissions, advertising, and administrative salaries, should never go into manufacturing overhead. These period costs are expensed directly on the income statement. Last year, a major retailer had to restate their financial statements because they incorrectly capitalized marketing costs as part of inventory. A $50 million error that could have been avoided with proper cost classification. Product costs flow through the balance sheet. Period costs land directly on the income statement. Remember this distinction. It's fundamental to GAAP compliance. Think of product versus period costs like two types of educational expenses. A textbook you'll use all semester is like a product cost. Its value persists over time. A one-time admission fee to a guest lecture is like a period cost. Its value is consumed immediately. Both support your education, but they're accounted for differently. Similarly, manufacturing costs become inventory assets, while non-manufacturing costs are expensed immediately. Our chair is now complete. All the sanding, staining, and finishing touches are done. Time to transfer its costs from work in process to finished goods. The chair's total cost is $750, 200 materials, plus 300 labor, plus 250 applied overhead. The journal entry simply debits finished goods for $750 and credits work in process for $750. Think of this transfer as graduation. After weeks of study and preparation, the student completes all requirements and receives a diploma. The manufacturing process is complete and the product is ready for the next stage, meeting a customer. A job well made is a cost well paid. When production is complete, the costs must follow. What would happen if we forgot to make this transfer? Take 5 seconds to consider the accounting impact. We'd overstate work in process and understate finished goods. Our balance sheet would be wrong, and we might make production decisions based on incorrect information. No sale is complete until the costs follow the revenue. This final transfer is crucial for matching principal compliance. When Custom Creations sells the chair for $1,200, they make two journal entries. First, they record the revenue, debit accounts receivable for $1,200, credit sales revenue for $1,200. Second, they recognize the cost, debit cost of goods sold for $750, credit finished goods for $750. This final transfer is like a product's graduation ceremony, moving from inventory asset to income statement expense, where it fulfills its destiny of being matched against revenue to determine profit. Think of this transaction like a theatrical performance. The revenue entry is like the audience applauding at the end of the show. The cost entry is recognizing all the expenses that went into creating that performance. Together, they reveal whether the show was profitable. Just as a theater doesn't know if a production is profitable until they match ticket sales against production costs, a manufacturer doesn't know a product's profitability until they match revenue against COGS. I once worked with a client who forgot to transfer costs from finished goods to cost of goods sold when they shipped products. Their financial statements showed huge profits and massive inventory, but their warehouse was nearly empty. Always remember this crucial final step. Now let's examine the hero of job order costing, the job cost sheet. This document is the financial biography of each product, telling its cost story from birth to completion. I consulted for a kitchen cabinet manufacturer that maintained beautiful job cost sheets, but nobody ever reviewed them after completion. When we finally analyzed them, we discovered they'd been losing money on every kitchen island for 3 years. These sheets aren't just record keeping, they're gold mines of business intelligence. Master the job cost sheet, and you'll be the person who saves your company from invisible losses. This document will make you the profitability hero. Think of the job cost sheet like a medical chart in a hospital. It tracks every treatment the product receives. It records vital statistics at each stage of development. It helps diagnose profitability problems. It provides historical data for future reference. Just as doctors use charts to provide effective treatment, managers use job cost sheets to make informed decisions. Financial schedule answers a crucial question. How much did it actually cost us to produce all the goods we finished this period? Let's walk through Custom Creation's schedule for 2024. They started with $35,000 of work in process, added $425,000 in direct materials, added $375,000 in direct labor, applied $480,000 in manufacturing overhead. That's $1,280,000 in total manufacturing costs for the period. Combined with beginning work in process, they had $1,315,000 in total work in process, ending with $40,000 still in work in process, resulting in $1,275,000 of cost of goods manufactured. Companies have been creating versions of this schedule since the Industrial Revolution. Whether tracking the cost of producing Model T Fords in 1908 or Tesla Cybertrucks today, the fundamental approach remains unchanged. Think of this schedule like a semester-end academic report. Beginning work in process is like the incomplete credits you carried forward from last semester. Manufacturing costs are like the new courses you took this semester. Together, they represent your total academic workload for the period. Ending work in process is like the incomplete courses you'll finish next semester. Cost of goods manufactured represents the courses you actually completed this semester. If ending work in process increased by $10,000, what would happen to cost of goods manufactured? Take 5 seconds to calculate. It would decrease by $10,000. More ending inventory means less was completed and transferred out. This schedule is the bridge connecting your production floor to your income statement. It shows how manufacturing costs become expenses as products are sold. Let's analyze Custom Creation schedule, beginning with $85,000 in finished goods, adding $1,275,000 in newly manufactured goods. They had $1,360,000 of goods available for sale, ending with $90,000 still in finished goods, resulting in $1,270,000 of unadjusted cost of goods sold. Notice that final adjustment for $15,000 of underapplied overhead. We'll explore that next. Think of this schedule like that expectations versus reality meme. The expectation is your beautiful finished goods inventory. The reality is what actually sold and at what cost. Think of this schedule like a retail store's inventory flow. Beginning finished goods is like the merchandise on your shelves at store opening. Cost of goods manufactured is like the new shipments arriving throughout the day. Together, they're the total merchandise available for customers to purchase. Ending finished goods is like the merchandise still on shelves at closing time. Cost of goods sold represents what customers actually purchased. I once reviewed financial statements for a client who couldn't understand why their gross profit margins kept shrinking. Turned out they were forgetting to adjust cost of goods sold for massively underapplied overhead. This seemingly small step can have huge implications for your bottom line. We've arrived at the final mystery of job order costing. What happens when our estimates don't match reality? And trust me, they never match exactly. There are only two possibilities. Either you applied too little overhead to jobs, or you applied too much. Applied is greater than actual, that's over-applied. Applied is less than actual, that's under-applied. Applied greater, over-applied. Applied less, under-applied. Let's see this in action with Perco's example. They estimated $640,000 in overhead and 160,000 direct labor hours, giving a rate of $4 per hour. Their actual overhead was $650,000. Their actual direct labor was 170,000 hours. Applied overhead, 170,000 times $4 equals $680,000. Difference, $680,000 minus $650,000 equals $30,000 over applied. Think of overhead application like weather forecasting. Predetermined rates are your forecast. Tomorrow will be 75 degrees. Actual overhead is reality. Today ended up being 78 degrees. Underapplied means reality was hotter than predicted. Overapplied means reality was cooler than predicted. Just as meteorologists adjust their models after comparing forecasts to reality, accountants adjust their financial statements for over-applied overhead. I know what you're thinking. Why not just wait until year-end and use actual overhead? Great question. But by then, you've already made thousands of pricing and production decisions. It's like deciding what clothes to wear after you've been outside all day. For the grand finale of our job order costing system, what do we do with this leftover balance? You have just two choices. Take the easy road and close it all to cost of goods sold, or take the more accurate road and allocate it between accounts. No other options exist. The simple method just debits manufacturing overhead and credits cost of goods sold for the entire $30,000. Easy. The proration method is more accurate but more complex. If Perco's $680,000 of applied overhead is distributed as 10% in work in process, 30% in finished goods, and 60% in cost of goods sold, then the $30,000 over applied overhead would be allocated proportionally to each account. Think of disposing overhead variances like distributing a tax refund. You could put all that refund toward one bill, or divide it proportionally among all your obligations. The variance represents a correction to previous estimates that should be allocated based on where those estimates were used. I once worked with a manufacturing client who had $200,000 of underapplied overhead, a massive amount. Using the simple method would have destroyed their quarterly profits. By allocating properly, they discovered that 70% belonged to ending inventory, which preserved their current income statement and properly valued their inventory for future periods. The easy way isn't always the right way. Proration takes more work, but gives more accurate financial statements. Let's explore how actual businesses use job order costing to make real decisions. This isn't just textbook theory, it's competitive advantage in action. Boeing uses job order costing for each 787 Dreamliner, with job numbers assigned by customer. When Emirates orders 3 planes with specific configurations, Boeing creates job number EM 2025-1, EM 2025-2, and EM 2025-3. Each plane might cost $250 million to build, but the specific customizations affect this significantly. Think of job order costing across industries like constructing different types of buildings. High-rise construction, massive scale, years-long production, hundreds of specialized workers, extreme customization. Custom home building, moderate scale, weeks of production, unique designs for each client. Commercial renovation, shorter time frame, specific tasks, unique requirements for each project. What would happen if Boeing didn't separate costs by customer order? Take 10 seconds to reflect. They wouldn't know which plane configurations are profitable and which are money losers. When a customer wants special entertainment systems or interior layouts, Boeing needs to know the exact cost impact. Job order costing isn't just for manufacturers. Service businesses need it just as much, if not more. Here's the deal. Law firm partners want to know which clients and which types of cases are actually making money. Without job order costing, they're flying blind. Think of job order costing in service industries like preparing different meals in a restaurant. Hospital patients are like diners at different tables, each ordering unique combinations of services. The medications and supplies are the ingredients. The doctors and nurses are the chefs. The hospital building and administration are the kitchen infrastructure. Each patient's bill should reflect their specific consumption plus a fair share of overhead. Think of a hospital as a factory where the patients are the jobs. Each patient has different materials, different direct labor, and requires different overhead. Last month, Mayo Clinic announced they're expanding their cost accounting system to better understand the true cost of complex treatments. With skyrocketing healthcare costs, knowing exactly what drives expenses is critical to their survival. Let's take overhead allocation to the next level. Basic job order costing uses one predetermined rate, but sophisticated companies use multiple rates for greater accuracy. Imagine Custom Creations has two departments, machining department and assembly department. Instead of one plant-wide rate, they calculate separate rates for each department based on the appropriate allocation base. Think of overhead rates like college tuition models. A plant-wide rate is like charging all students the same flat tuition regardless of their major. Departmental rates are like charging different amounts based on your field of study. Engineering students pay more because of expensive equipment and labs. Liberal arts students pay less because their education requires fewer physical resources. Consider a job that uses 10 machine hours in machining and 20 direct labor hours in assembly. Calculate the overhead applied with both methods. With the plant-wide rate, 30 direct labor hours times $50 equals $1,500. With departmental rates, 10 machine hours times $60, plus 20 direct labor hours times $25 equals $1,100. That's a $400 difference on just one job. Multiply that by hundreds of jobs, and you're looking at massive cost distortions. I worked with a furniture company that used a single overhead rate based on direct labor hours. Their high-end, hand-carved chairs showed huge profits, while their machine-made tables seemed barely profitable. When we implemented departmental rates, the truth emerged. They were losing money on those profitable chairs because the single rate severely underallocated costs to labor-intensive products. As a cost accounting professional, you'll likely be asked to design or improve job cost sheets. This is your chance to shine. Let's examine a comprehensive job cost sheet for Custom Creations' luxury hotel chair order. Let me walk you through the key sections of this detailed job cost sheet. At the top, we have job identification information. In the middle sections, we track direct materials by requisition, direct labor by time ticket, and overhead by department. At the bottom, we summarize all costs and calculate the unit cost. Think of this job cost sheet like a patient's medical chart. It documents every treatment the product receives. It tracks vital signs at each stage of development. It creates a complete history from birth to completion. It allows for diagnosis of profitability issues. Just as doctors use charts to provide better care, managers use job cost sheets to make better decisions. This job cost sheet is like a product's financial DNA. It reveals exactly what makes up its cost structure and helps identify its profit potential. What additional information might be useful on this job cost sheet? Take 10 seconds to jot down at least one idea. You might have thought of estimated versus actual costs for variance analysis, profit margin based on selling price, quality inspection results, production bottlenecks or delays, or special customer requirements. This single document tells the complete financial story of this job. Notice how it captures everything: direct materials, requisitions with dates and quantities, direct labor by department, and overhead applied using departmental rates. This level of detail is critical for accurate costing. There are only two ways to set prices: educated guesses or data-driven decisions. Guess which one leads to bankruptcy. Let's see how job order costing drives real pricing decisions. Custom Creations has a new dining table project with these costs: direct materials, $1,800, direct labor, $1,500, applied overhead, $1,000, total cost, $4,300. With their target 25% profit margin, their minimum bid price should be $5,375. Think of job costing for pricing like building a house. Without a blueprint and cost estimate, you're just guessing what materials you need and how much they'll cost. With proper job costing, you have a detailed breakdown of every component and its cost. A contractor who guesses on bids will either lose money or price themselves out of the market. Similarly, a manufacturer without accurate job costing will either underprice and lose money or overprice and lose customers. I once consulted for a custom cabinet shop that had been pricing by feel for 20 years. The owner insisted he knew his costs. When we implemented proper job costing, we discovered he was losing money on 30% of his jobs. Some projects he priced at a 40% margin were actually giving him just 5%. Last quarter, Ethan Allen announced they're implementing enhanced job costing to fine-tune their pricing strategy for custom furniture lines. They expect this to improve gross margins by 3% within a year. That's millions in additional profit. Every manufacturer stands at a crossroads with component parts. Make them in-house or buy from suppliers. Without job costing, you're choosing your path blindfolded. Custom Creations is deciding whether to make chair frames in-house or purchase them. The supplier quotes $120 per frame, while their job costing system shows an in-house cost of $125 per frame. $45 materials, plus $30 labor, plus $50 overhead. At first glance, buying seems cheaper. Think of make or buy decisions like choosing between cooking at home or ordering takeout. Cooking at home uses ingredients you already have, plus whatever specific groceries you need for that meal. Takeout seems more expensive per meal, but you avoid buying kitchen equipment and learning to cook. This analysis initially suggested buying frames. However, when we dug deeper into the overhead, we discovered $30,000 of the applied overhead was fixed costs that wouldn't be eliminated if production stopped. The relevant cost comparison was actually buy $120,000, make $95,000 variable costs plus $30,000 fixed costs equals $125,000. But if that equipment and factory space would otherwise sit idle, the fixed costs were irrelevant for this decision. This insight saved the company from an outsourcing mistake that would have cost them $25,000 annually. Cost accounting separates facts from feelings in business decisions. Custom Creations analyzed their top 3 clients. Client A, a luxury hotel chain, generates $250,000 in revenue, but has $210,000 in total costs, giving them just a 16% profit margin. Client B, Design Studios, brings in less revenue at $150,000, but their total costs are only $114,000, resulting in a 24% profit margin. Client C, Retail Stores, has $200,000 in revenue and $152,000 in costs, also giving a 24% margin. Think of customer profitability like different friends in your social circle. The friend who's always planning elaborate, expensive outings might cost you more than they're worth. The low-maintenance friend who genuinely appreciates simple get-togethers might be more valuable. Without tracking the costs of each friendship, you might invest your time inefficiently. Which client should Custom Creations focus their growth efforts on? Jot down your answer and reasoning. Without job costing, they might chase Client A, their biggest revenue customer. But the data shows Client B and Client C deliver better margins with fewer special requirements. This completely changes their growth strategy. Job order costing principles apply not just to products, but to customers too. Each customer becomes a job with associated revenues and costs. This analysis transforms your marketing and sales strategy from revenue-focused to profit-focused. Let's talk about what can go wrong with job order costing. These are the traps I've seen companies fall into over and over. I consulted for a kitchen cabinet manufacturer that used square footage of cabinet space as their allocation base. Seems logical, right? But their overhead was driven primarily by CNC machine time, not cabinet size. Their small, intricate cabinets were significantly undercosted, while their large, simple cabinets were overcosted. They couldn't figure out why competitors were stealing their small cabinet business while leaving the large cabinets alone. Think of allocation bases like fitness trackers. Using the wrong allocation base is like tracking only steps when your primary exercise is swimming. It measures something, but not the thing that actually matters. Just as fitness progress requires the right metrics, accurate costing requires appropriate allocation bases. Using the wrong allocation base is like using a bathroom scale to measure ingredients for a cake recipe. The measuring tool itself works perfectly, but it's completely inappropriate for the task. Here's the thing about costing systems: garbage in, garbage out. If your allocation base doesn't match your cost drivers, your entire system will produce misleading information. Days of paper job cost sheets are disappearing. Modern ERP systems like SAP, Oracle, and NetSuite integrate job costing directly into their manufacturing modules. Last year, Shopify announced a new job costing module for small manufacturers, showing how important this functionality is even for smaller businesses. Think of a digital job costing system as mission control for your manufacturing operations. Every cost, every hour, every transaction visible in real time on your dashboard. Think of digital job costing systems like the evolution of navigation. Paper job cost sheets are like paper maps, functional but static and prone to error. Basic computerized systems are like early GPS, more accurate but still requiring manual input. Modern integrated systems are like today's navigation apps, real-time updates, predictive analytics, and integrated with other systems. I consulted for a cabinet manufacturer, transitioning from paper job sheets to a digital system. The owner was resistant, saying, "We've always done it this way." 6 months after implementation, he pulled me aside and confessed, "We found out we've been losing money on every kitchen with an island for years. This system paid for itself in the first month." It's like that "how it started versus how it's going" meme. Paper job sheets versus real-time digital dashboards. The difference is nothing short of revolutionary. You've now mastered the complete system of job order costing, from raw materials purchases all the way to disposing of overhead variances. You understand every step of this powerful accounting system. From beginning to end, job order costing captures costs as they enter the business, tracks costs as they flow through production, assigns costs to specific products, adjusts costs at period end for accuracy, reports costs on financial statements, analyzes costs for better decisions. Next time you see a custom furniture piece, a specialized machine, or even a consulting project, you'll be the person who thinks, "I know exactly how they track the costs for that." While others see just the price tag, you'll see the entire cost flow system behind it. Think of your job order costing knowledge like a financial superpower. You've gained X-ray vision to see through surface-level prices to the cost structures beneath. You've acquired the ability to transform raw financial data into strategic business insights. You now possess the skills to detect invisible profitability problems and solve them before they damage the company. I'll leave you with this story. A furniture manufacturer had been in business for 35 years, always profitable, but never spectacularly so. The founder's daughter took over and implemented proper job order costing. Within 6 months, they discovered 20% of their products were losing money, but 30% had profit margins over 40%. They pivoted the business to focus on those high-margin items, and within 2 years, had doubled their overall profits. Same factory, same workers, just better information. Next time, activity-based costing, when job order costing gets a precision upgrade, you won't want to miss it. Remember, what gets measured gets managed. What gets costed correctly creates competitive advantage. This is your accounting professor signing off. Your assignment is to see cost flows everywhere you look. Because once you understand job order costing, you'll never see business the same way again.